Today we are going to be looking at IS-33, and IS-33 is earnings per share EPS. Then in this standard, in today's lesson, we are going to be taking care of the objectives of IS-33, then why we calculate EPS. Then thirdly, we have the scope of IS-33. The fourth area we're going to be looking at is the meaning of words used in EPS calculations. Then fifth is the EPS and PE ratio. The PE stands for price earning ratio and their formulas. Then furthermore, we'll be taking a look at the types of EPS calculations. Then calculations on basic EPS, EPS when preference share is a liability, and calculating EPS when preference shares is an equity instrument. Also EPS when there is cumulative preference shares, and treating changes in number of shares during the year, that's during the accounting period, and how EPS should be calculated then. Now there are different calculation ways for EPS depending on the scenario, and here we have about 5 scenarios for basic EPS when EPS is a preference share and it is a liability, when calculating EPS when preference shares is a liability, that should be the second one. Calculating EPS when preference shares is an equity instrument. Then EPS when cumulative preference shares exist. And finally, treating changes in number of shares during the year and how EPS should be calculated then. We have 5 of them, and we'll be looking at calculations in each one of them in today's class. Now we'll do a recap in a particular area, which is the type of EPS calculation. Now we have two types there, and the first type will be taken care of in this lesson. We would have 2 parts of this lesson. The first type will be taken care of in this lesson, then the second type will be taken care of in the part 2. So we would not rush things and would understand this better. So we'll move over to the objectives of IS-33, which is the first thing we are going to look at here. Now, according to IS-33 by the standard, it generally has 3 objectives. So the first one is to calculate the EPS, to determine how much of profit for the year can be allocated to each equity share held by ordinary shareholders. The second objective is to present the EPS. Of course, when you'd calculate, you'd have to present. Then finally, the objective is to compare performance of public companies, and comparing performance has 2 areas, 2 ways you could compare performance: financial performance of companies, and the first way is with past records, with previous records. Then the second is with competitors, so you could compare with your previous records, your previous years, 2017 compared with 2016, to check the growth or decline. And also you can compare with competitors, now competitors in your industry or similar or related industries. So we have both of them there. Then we'll check it out in summary. This is, so the first you do is to calculate, the second you do is to present, the third you do is to compare. Calculate, present, and compare, CPC for short form. So we'll move to the second area where would cover, and it is why we calculate EPS. And EPS is often used by investors. Of course, investors are shareholders too, to value how much of their shares held in a company has been able to in turn generate earnings that could be attributed to them, that is, that could come to them only. I'll take it again. EPS is often used by investors, shareholders, to value how much of their shares held in a company has been able to in turn generate earnings, how much each share has been able to generate earnings, that's profits, and that profit is the profit that is only attributed to the ordinary shareholders, and the ordinary shareholders are the owners of the business. Now we'll go further, and it says these shareholders are ordinary equity shareholders. Now EPS is only concerned with ordinary shareholders and the profit attributed to them. Ordinary shareholders, I'll take it again, and the profit attributed to them. Now it says furthermore, EPS is used to calculate the price earning ratio. I expanded it here. I wrote the price of shares divided by the earnings per share ratio, which could indicate if a company is overvalued by its share price in relation to what it earns, and what it earns is the profit attributed to the shareholder, and vice versa. So if it has a low profit generated to the shareholders, if the shareholders for investing get a low profit from what they invest compared to the share price, how much they buy each shares, so you could see they are not gaining. That company is overvalued. Its share prices is higher than what it can generate. So you see, you could use it to know if a company is overvalued or undervalued by using how much it actually generates to the shareholder on each share. So it says EPS has been standardized to make comparison easier between companies, and it is one of the easier ways to compare returns on your investment in different companies, that's portfolio, to know which gives you more earnings per share. Now the word earnings per share has been written in full here. I'll take it again. EPS has been standardized to make comparison easier between companies, and it is one of the easier ways to compare returns on your investments even in different companies, to know which gives you more earnings per share. Now the name is written plainly here for us to understand what it means. So we'll move over to the scope of IAS 33. Now the scope of IAS 33 means, what does IAS 33 cover? What does it talk about? What doesn't it cover? What's it about in general? So it says IAS 33 is strictly for companies quoted on the stock market, which have a share price, and companies about to be quoted on the stock market. Now IAS 33 has nothing to do with, say, one-man business or partnership companies. It's strictly for companies quoted on the stock market that have share price. Why is it for them? It's because they have share price and they have investors willing to invest in it. And companies about to be quoted on the stock market. And the second area of the scope is when a company owns a subsidiary, its EPS is calculated on the consolidated statement result. Now, owning a subsidiary in financial reporting, you'd have to consolidate your accounts. That consolidate means bring them together and report as one entity. Now, subsidiaries are companies owned by a parent company. Now, the owned is from the percentage of 51% to 100% of the subsidiary company owned by a parent company. Now, the term owned means the parent company has majority of its shares. It has over 50%, over about 51% to 100% of the shares in the subsidiary. Then that company becomes the parent company. Now, in line with financial reporting standards, the books of accounts have to be consolidated, have to be presented together for both companies. Now, it says when calculating EPS on companies that own subsidiaries, you'd calculate the EPS on the consolidated statement, not the separate accounts for both of them. So we'll go to the meaning of words used in EPS calculations. Now we have about, let's see, 1, 2, 3, 4, 5, 6. We have about 6 words here, 6 of them here. The first is earnings. So we have what are earnings according to IAS 33. Now, earnings are profits available to equity shareholders, as we said. IAS 33 has nothing to do with other types of equity holders. It's concentrated on ordinary equity shareholders rather. That is the profit or loss. Now, the earnings is the profit or loss after deducting preference dividends. Now, the earnings is the profit or loss. Obviously, before this profit or loss, you would have deducted your tax figure from it. It is the profit or loss after deducting your tax and your preference dividends. Now, for consolidated statements, after deducting the earnings attributable to minority interest or NCI, that's non-controlling interest. Now, what we are concerned here is just the profit for the ordinary shareholders, for the people that bear the risk of the business. For the owners of the business, we are looking for the profit that is attributable to them, the profits that they get from the business. Now, the earnings are on continuing operations. We'll treat that in an example further. The second one we have is shares, and it says shares are units of ownership, interest in a corporation or financial assets that provides for an equal distribution in any profits, if any are declared, in form of dividends. Now, it says the two main types of shares are common shares and preference shares. Now, common shares are ordinary shares, and we have preference shares. Now, for calculating EPS doesn't care about the preference share dividend. It's only looking for the ordinary shareholders dividend there, the ordinary shareholders earnings there rather. So, after talking about that, we move to the market price of shares. Now, it says the market price of a stock is the price that it sells for on the open market at a given point in time. Now, the open market we are talking about is the stock market. It says the market price of a stock is the price that it sells for on the open market at a given point in time. Now we would see that the market price of stocks fluctuates often. That's why we have at a given point in time there, and the market price of shares will be used often in this class. So let's go over to the next one. It says ordinary shareholders. We'll have the definition of them to save our time. It says ordinary shareholders are it's supposed to be ordinary shares are shares in a company that are owned by people who have a right to vote at the company's meetings on and receive part of the company's profits after the holders of preference shares have been paid. Now, for ordinary shareholders, they have the right to vote, and once you have the right to vote, you are perceived as the owner of the business because you take decisions for the business. You make decisions on who will take the decisions for the business. Now, they also rather receive parts of the company's profits depending on the number of shares they own or possess. Now, a person who has a 10% shareholding in a company would not get the same amount of dividends as a person who has, say, 0.01% shareholding in a company. So in line with the definition of shares here, it says shares are units of ownership. Now the person that has 10% shareholding, let's say the company has 5 million shares and 10% of 5 million is 500,000, has 500,000 shares in a corporation, and it provides equal distribution. So someone who has 10% shares and the company generates a profit which it wants to distribute as dividend of, say, 10 million naira. So the person with 10% shareholding gets 1 million naira if it is distributed equitably. The person with 0.01% gets whatever amount it is after calculating it on the general dividend that is to be shared. Now it says, okay, the word equitable, equal distribution in any profit based on the amount of shareholding you have in that company. So given the definition of ordinary shareholders here, and we'll move over to the basic EPS. What is a basic EPS? Now, basic earnings per share tells investors how much of a firm's net income was allotted to each share of common stock. Now, common stock here is ordinary shares. It is reported in a company's income statement. It says basic earnings per share tells investors how much of a firm's net income was allotted to each share of common stock. We'll do the calculations later on. This is where we'll focus on in this part 1. Then the part 2 will take care of the diluted EPS that we're going into now. It says diluted EPS is a calculation used to gauge the quality of a company's earnings per share. Now this is the condition. This is what makes it different. If all convertible securities are exercised. Now the difference between both of them is the existence of convertible securities. Now it goes on and it says convertible securities are all outstanding convertible preference shares, convertible debentures, stock options, warrants. We'll be looking at those in today's class. Now we'll go over to EPS and price earning ratio formulas. The first is the EPS formula, and the EPS formula is here. Profit for the year, that is the profit attributable to ordinary shareholders, and that profit is the profit after tax less payments of preference dividends to preference shareholders. Then this is divided by the number of ordinary shares in issue, the number of ordinary shares that the company has in issue, that the company has issued and is in existence. Now, as we said before, the profit for the year attributable to ordinary shareholders has this formula. It says profit after tax less dividend paid to preference shareholders. We'll go over to the price earning ratio formula. And the price earning ratio formula is the current company share price, that is the market price. We gave the definition above here. Let's look for it. Yes, and the market price of a stock is the price that it sells for on the open market, on the stock exchange market at any given point in time. So it says the current, now it's talking about the current price, the current share price of the company divided by the EPS calculated, and the EPS formula is above. Now we go to the types of EPS calculations. Now, as stated before, the first is the basic EPS, the second is the diluted EPS. And it says both types of calculation of EPS differ when there is a potential ordinary share. And we had an example here, we had the definition here, and that potential ordinary share is a convertible security. We gave examples of convertible securities here: convertible preference shares, convertible debentures, rather, stock options, then warrants. So going back to where we stopped here, it says both types of calculations of EPS differ when there is a potential ordinary share. Potential ordinary shares are financial instruments or contracts that may entitle its holders to ordinary shares at some time in the future. That is why it is convertible. It can be converted to ordinary shares in the future. So we gave examples here again: convertible liabilities and equity instruments. So we have convertible debentures and convertible preference shares respectively, share options, and examples of share options are choice to purchase new ordinary shares sometimes in the future at an agreed price, are all part of, in quotes, potential ordinary shares here. And we move to the basic EPS calculation. We have the formula for the basic EPS, which is the same formula for the general EPS if some circumstances don't occur. It says net profit or loss to ordinary shareholders for the period is divided by the weighted average number of shares in issue during the period. And it says when there is a loss, invariably EPS will be negative. If there is a loss, automatically EPS would be negative. It doesn't matter the number of shares that are issued, since the numerator is already negative, and you can't have negative number of shares issued, so it would automatically be negative. Then we have calculations of basic EPS when. So we'll be taking a look at each one of them here, and this is a point where we have to be serious because the calculations are about to come in. It says we'll be having calculations when. The first one is preference shares is a liability. You'll get an example on that. The second one is when preference shares is an equity. The third one is when there is cumulative preference shares. The fourth one is when there are changes in the number of shares during the year or period. Fifth one is when there's a bonus issue of shares. Sixth is when there's rights issue of shares. Now we would cover these 6 with examples, so you could get, I would have to get about 6 or 7 examples covering each one of them. And we will quickly take a look at the definition of preference shares. Preference shares must be classified as equity or liability in accordance with the rules in IAS 32. And IAS 32 is financial instruments, the presentation of financial instruments. If a class of preference shares is classified as equity, now this is how to treat it when it is classified as equity. Any dividend related to that, you pay dividends to equity holders. Now, when the preference share is treated as an equity in line with IAS 32, you should deduct the dividend from profit or loss from continuing operations as stated above. Now, if it is a liability, if it is classified as a liability in line with IAS 32, and any dividend related to that share is recognized as borrowing cost in the statement of profit or loss. Now, borrowing cost is just as the interest that is incurred in borrowing for financing a project, for buying anything related to your business. Now, it is the interest you pay for getting finance that is borrowing cost. Now, we would say if it is a liability, if preference shares is treated as a liability, a debt, any dividend paid to it should be treated as borrowing cost. If it is an equity, it should be deducted from the profit or loss from continuing operations as stated above. Now, the first example is the basic EPS with preference shares as liability. We have it here. The first here is preference shares as a liability. The first example here is in line with it. It says in the year ended 31st December year 1, entity G made profit after tax of 3.5 million. That's 350,000. Of this, 3 million naira, or whatever currency you use, dollars, pounds, euros, Australian dollar, whatever you use, was from continuing operations, and 500,000 naira from discontinued operation. Now, we talked about it related to only continuing operation. Out of this 3.5 million, 300,000 was from continuing operation, while 500,000 was from discontinued operations. Now, we are only concerned with the continued operations, and it further says ordinary dividend of 150,000 and preference dividend of 65,000. The preference shares were correctly classified as liabilities in accordance with IAS 32. Entity G has 1 million ordinary shares in issue throughout the year. Entity G's basic EPS for the year ended 31st December year 1 is calculated as follows. Now, this is how we calculate it. The formula for EPS is here again. Net profit or loss attributed to ordinary shareholders during the period is divided by the weighted average number of shares in issue. Now, since we are concerned with only continuing operations, we have 3 million naira here. We also have 3 million naira here, and it's supposed to be divided by 1 million shares, 1 million number of shares. Then we have the 1 million number of shares here, although it was not written there. We have it says entity G has 1 million ordinary shares. We're only concerned with ordinary shares. Now we'll divide the 3 million rather by 1 million ordinary shares, and it will give us 3 naira per share. So for each share, an investor gains 3 naira as his own part of the profit for whatever amount of shares he invests in the company. The 3 naira is the amount that is attributable or that will be given to him, or that can be given to him as his right on every share he buys in the company. So that is basically it. You could use this figure to compare different companies and know which one to invest in. The higher the number, the more attractive the investment is. So we'll move over to basic EPS with preference shares as equity. Now the first one we took was with preference shares as liability here. Now the example 2 is with preference shares as equity. And we have the same example here, just the difference here is that the preference share dividend is, it says the preference shares were correctly classified as equity in accordance with IAS 32. So now the first one classified preference shares as a liability here. Second example is classifying preference shares as an equity here. The same question, nothing changes apart from that. How do we treat it? The same formula, net profit or loss attributable to ordinary shareholders during a period. You divide it by the weighted average number of shares in issue during the period. Now we have 3 million from continuing operations. We don't care about discontinued operations here. Then we less 65,000. Now that preference shares is classified as equity, that means the 65,000 has not been originally deducted from the 3 million that we have as profit after tax. Here it says entity G made profit after tax. The 3 million we have there is profit after tax. Then after the profit after tax, you divide the profit between the preference dividend holders and the ordinary shareholder, preference shareholders rather, and the ordinary shareholders to take their part. Now since we are concerned with only ordinary shareholders, we would have to deduct what preference shareholders get as dividends. So we'll have 3 million less 65,000. It would give us about 2,935,000 if I'm not wrong. Then we'll divide that by 1 million number of shares. It will give us 2.95 or 2.935 per share. You could approximate it here as it was approximated to 2.94 per share. This means for every share the ordinary shareholder has, it generates 2.94 naira as the cash or the amount or his gain that will be given to him, that can be given to him per share, that is his reward per share from investing in that company. Then we'll take a look at cumulative preference shares as we move on. Now, cumulative preference shares, it says some preference shares are cumulative preference shares, and this means that if a company fails to declare a preference dividend in a period, the holders are entitled to receive the missed dividend sometimes in the future. Now I would explain if a company does not give dividends this year, that is 2020, preference shareholders are still entitled to carry over that missed dividend to the next year, to be added to their next year's dividend for them to get. Now, that is what cumulative preference shareholders basically enjoy. So, in other words, their right to receive a dividend accumulates, it adds up, it accumulates when a dividend is not declared. If there are cumulative preference shares in issue, the dividend must be deducted from the profit or loss from continuing operations, which you always get about, regardless of whether the dividend has been declared or not. So basically, you don't care if it has not been declared. If it has been declared, you still have to deduct it as long as it's a cumulative preference share. Now we have an example there, which is example 3. It says in the year ended at 1st November, year 1, entity G made profit after tax. Now this is profit after tax. This is not the earnings from continuing operations of 3.5 million naira. Entity G has 1 million naira, 10% preference share capital in issue. And what this means is that the preference shares that has been issued is 1 million naira in value. Now the 10% in front of the preference shares is the dividend that the people who own the 1 million naira preference shares get. So out of the 1 million naira, 10% is to be paid as dividend yearly. That's what it means. 10% preference share capital on issue. That means out of this 1 million naira, 10% is to be paid yearly. And so if I have, say, 50,000 out of that 1 million naira preference shares in the company, I would get 5,000 yearly as my dividend payment for owning that preference shares. Now it says this would entitle investors to receive dividend of 1 million naira. I said before, that's 10% of 100,000, that's 10% of 1 million if declared. Entity G has 1 million ordinary shares in issue throughout the year, so it doesn't change, it's still the same amount. Entity G's basic EPS for the year ended at 1st December year 1 is calculated as follows. So we have the same formula here: net profit or loss attributable to ordinary shareholders during a period divided by the weighted average number of shares in issue during the period. Now we have, like I said before, that 3.5 million is the profit or loss after tax, that is PAT, and is not earnings. We gave the definition of earnings earlier before. You could go back to the definition of earnings and learn what earnings is. So we have 3.5 million less 100,000 as the dividend that will be paid on 1 million naira preference shares. Now we are not taking the full value of the preference shares, we are just taking the value of the dividend. The 10% in front was for us to calculate the value of the dividend on the 1 million naira preference shares. So we have 100,000. We have 3.5 million less 100,000, and you do this first and you divide it by 1 million shares. So we have 3.4 naira per share. So if I am, or if you are a shareholder, and for each share you invest in this company, for each share you buy in this company, you have a return per share of 3.4 naira of whatever you invest. So that is basically it. So it doesn't take into account if it has been declared or not. If the 100,000 When they say declared, it means if it has been said that it will be paid during the year which the profit was made. You could keep it over, or you could pay it as dividend. The company, when I say you, could keep it to invest more, to reinvest, or they could say, okay, let's pay it since we have nothing to do with this cash again. So whether it is declared or not, you would deduct it to calculate your EPS figure. Then we move to changes in the number of shares during the period. Now, a company could issue shares, as we all know. The company could issue shares, and we have different ways, different methods of issuing shares. But let's go through the notes in this. It says IAS 33 gives guidance on how to incorporate changes in share capital during the period into the calculation of weighted average of shares that must be used in EPS calculation. Now, the aspect of changes in number of shares during the period only affects the denominator here, which is the weighted average number of shares in issue during the period. It doesn't affect the net profit or loss attributable to ordinary shareholders, which is the same calculation. This net profit or loss is the same as the earnings, and the earnings is your net profit after tax, that's PAT, less dividends paid to preference shareholders, dividend payable to preference shareholders, since we are only looking for equity shareholders. And I said the profit after tax is shared between the preference shareholders and the equity shareholders. Now, since we are only looking for the equity shareholders, we would have to less the preference shareholders, so we know what goes directly to the ordinary equity shareholders. Here we have there are different ways in which the number of shares may change, as which they can increase or which companies can issue shares. We have issue for full consideration. Companies could issue shares, and the payment takes the whole value of the market value. Now, if the market value is 5.4 naira per share, the company issues it at the market value of 5.4 naira per share, issued more shares, new shares at 5.4 naira per share. Now, issues for no consideration is basically free, and when it's free, the net asset figure, you're not getting money in return, so your net asset figure remains the same, but your number of shares increase. The number of shares increase while the value of your net assets remains the same. You're not getting anything as capital, you're issuing it for free, so you're just increasing the number while the amount of capital does not increase to you. Then we have bonus issues, we have share splits, and we have reverse share splits. Now, because of our time, bonus elements and other issues, rights issues, we would look at that. So an example here, example 4, of calculating when there are issues of shares within the period or within the year. And as I said, it affects only the denominator here, which is the weighted average number of shares. So let's see how to get the weighted average number of shares when there are issues done. So here we have question example 4, time apportionment to find weighted average, and the weighted average here means weighted average number of shares. So on January 1st, on 1st January, a company had 5 million ordinary shares in issue. Then on April 1st, 1st April, 1 million new shares were issued in addition. On 1st July, 1 million again shares were issued. On 1st November, 500,000 new shares, more shares were issued. all issues were at full market price. Now the weighted average number of shares is calculated as follows. We have the date of issue, we have the number of shares, we have the time factor, and we have the weighted average number. Now how did we get all these? The date, obviously the first one starts from 1st January, and for the period from January to January, February, March, since it was April 1st, that means April is in another section. So we have January, February, March. For those 3 months, the amount of shares the company had is 5 million naira. So from January, February, March, the company owned 5 million, or the company issued or had 5 million shares in issue. 5 million number, now we are dealing with number, not amount here. 5 million number of shares issued. So we have 3 months here, January, February, March. From April 1, we issued extra shares. So as at April 1, we didn't have 5 million shares again, we had more than that. So we have 3 months here. You divide 3 by 12, then you use it to multiply the 5 million shares that we owned for the first 3 months of the year. Now I'm sure we know how we got the 12. The 12 represents 12 months. The 3 months represents 1st of January to 31st of March. So if we multiply 5 million by 3 divided by 12, we have 1,250,000 as the number of shares based on weighted average number. Then on 1st April, we issued 1 million extra, as in the question here. Total number of shares from 1st April became 6 million, as down here. 5 million plus 1 million, we have 6 million shares. And now we still issued at July, so the period for which we had 6 million shares starts from April, May, June. So July 1, we issued another extra 1 million. So from July 1, we had more than 6 million shares. So April, May, June, that's also 3 months. So 6 million times 3 over 12, we have 1.5 million, or 1,500,000, 1500000. Then going on an extra 1 million issue of shares, the same process goes on from 1st July here. We calculate 1st July to the month before November, which is October 31st. So we have July, August, September, October, that's 4 months. We do the same process. We add 6 million plus 1 million to give us 7 million at that period. We multiply, we get the value. We do for the last issue, which is November. Now the last issue takes from the month of the last issue to December, that is the last month of the year. So that is 2 months, because we have November, December. It was issued on November 1, so November becomes part of the month. So we have November, December. 2 months. Total shares in issue is 5 million. 7,500,000, 7.5 million. You do the same process. Now the total weighted average shares, you add 1.25 million plus 1.5 million, 1500000 plus 2.33333 million plus 1.25 million. So in total we have approximately 6.3 million shares as the weighted average. Now the calculations are here. We have 6.3 million shares as the total after adding each. Now we will notice that the months must have a total of 12 months irrespective. So we have 3 months for the first one, 3 months for the second one. Total is 6 plus 4, we have 10 plus 2, that's 12 months in total. So it must be complete there. And we move over to bonus issues of shares. Now that the previous one we did here is how to calculate the weighted average number of shares in the year. That is the denominator down there, as I said. And we have bonus issue. A bonus issue of share, also called a scrip issue or capitalization issue, is an issue of new shares to existing shareholders in proportion to their existing shareholdings for no consideration at all. In other words, the new shares are issued free of charge to existing shareholders. Now, this bonus issue is not given to the public, it is given to people who already own shares in that company. Now, this bonus issue, how do we share it among them? We share it based on their percentage earning in the company, or their percentage ownership in the company. As I said, the 10% guy gets more than the 1% guy when a bonus issue is made, and it's free of charge. They give you free. So we have the formula for bonus issue, the fraction to get it as number of shares in issue after the bonus issue over number of shares in holding before. Now, before the new shares are given to you as an existing shareholder in the company, and after. So the after is the numerator, the before is the denominator, A over B. So we have example 5 here. It says a company has 4 million number of shares in issue. It has made a 1-for-4 bonus issue. Now this shouldn't scare us. 1-for-4, it means for every 4 shares you own, you get 1 extra share for free. It's like promo. So we would say the bonus fraction, as we said, the same formula up here, the same formula comes down here. Number of shares in holding after the bonus issue, number of shares in holding before. So before the bonus issue, I had 4 shares. Now they give me 1 shares. My total share becomes 5 shares as at current. So I have 5 divided by 4, as I said, after over before, new over old, 5 over 4. Number of shares in issue after the bonus. Now this is the total number of shares that the company would now own if it gives 1 to 4. So we have 5 over 4 times 4 million. So we have 5 million shares in total. It's quite easy because if you divide 4 million by 4, you get 1 million, then you add the 1 million to the 4 million, you get 5 million total shares. The calculations are quite easy here. So we move over to example 6 on bonus issue. Now we'll be going further. It says company C has a 31st December financial year end on 1st January year 5. It has 4 million shares in issue on 1st January year 5. Now we'll take note of the years. The years are very important to avoid confusion. That's why I highlighted them. It's made a 1-for-4 bonus issue. The financial results of company C in year 4 and year 5 were as follows. So it has total earnings year 5, year 4. So take note of the positioning. Luckily we have the same total earnings here. And note it was written total earnings here, not profit after tax. Now this is what we are actually looking for, the 20 million itself. And it continues to say there were no share issues in year 4. So it's direct, it's simple here. We have the earnings divided by the number of shares. So 20 million divided by 4 million shares gives us 5 naira per share. 5 naira earning for every 1 share you own in the company. So if we were given profit after tax, note that we would have deducted the preference shareholders dividend part out of it to get the earnings. Now that's the basic difference between both of them. And that's for year 4 here. Now we have 2 years, year 5 too. For year 5, since there was an issue in year 5, not in year 4, it becomes a little bit more complex here. How do we do year 5 zone? It says it could be calculated for year 5's financial statements as follows: by taking the number of shares for the current period and previous period and total number of shares after the bonus issue. The weighted average number of shares in the current year using the method explained earlier is calculated as follows. It's basically the same thing we did in the previous one. So we have 1st January to 31st June as 6 months. The question here, it says, okay, on 1st July year 5, so we have January, the year starts from January and ends December. That's the company year, because it says company C has a 31st December financial year and a year has 12 months. So if we go back, we'll start from January 1st January to 31st December. Now, since half of the year, which is the other half of the year, which is 1st July year 5, we had 6 months before then: January, February, March, April, May, June. 6 months. So we had 6 months of owning 4 million shares before new shares were issued for 144. The same here, 6 months, 1st January to 30th June, 4 million naira. The time factor is 6 months over 12 months. Now, since there's bonus issue, we use the bonus factor, which we got previously, as 5 over 4. And we'll do the multiplications. 4 million times half, 6 over 12 is the same as half of the year, times 5 over 4. It gives us 2.5 million. 2500000. We could confirm that with our calculator. Now, from the other half of the year, 1st July, we issued an extra 1 million shares. So our total share number is 5 million as at the current date. The remaining half, it goes to the end of the year. That's 6 months again. 1st July to 31st December would have 2.5 million also. Now, the bonus factor is used on the months previous to the 1st July. So we have the previous one here being 1st January, 30th June, having the figure of the bonus factor. So we do it like that and we get the 2.5 million. We have the sum to get the weighted average number of shares during the period at 5 million also. So that's how we get the weighted average number of shares when there is a bonus issue. Then I said the numerator still remains the same, which is the method of calculating the earnings. Now the problem is the denominator, which has different calculations based on the circumstance. Now the calculations are similar, just based on the circumstance that they slightly differ. So rights issue of shares. Now when there is rights issue, what is a rights issue? A rights issue of shares is an issue of new shares for cash. Now, bonus issue, there was no cash. Rights issue, there is cash, where the new shares are offered initially to current shareholders in proportion to their existing shareholding. The issue price of new shares in a rights issue is always below. Now, a rights issue has the same proportion as bonus issue based on the percentage of shares owned in the company, but the difference is: 1, there is cash for rights issue, there is no cash for bonus issue. 2, rights issue is below the market price. Bonus issue doesn't have a price at all. So this means that they include a bonus element. The bonus element is the discount in price, the reduction in price for them. They are giving them cheaply to existing shareholders. It is to existing shareholders only. Taking into account in the calculation of weighted average number of shares, also notes that any comparative must be restated by multiplying them by the inverse of right issue bonus fraction. Now we have the formula here. It says actual com right price divided by theoretical x right price. Now this is not complex, these are not complex words, so we'll take a look at the meaning of each one of them. First one is the actual com right price. What is the meaning of that? It means the market price of the shares before. One is simply before, one is simply what it should be. Before is actual com right price. Before the right issue, what was the price of the shares in the stock exchange market? That is the market price of the shares before the right issue. And the theoretical X right price is the price of that shares that it ought to be in theory after the right issue. It is the weighted average price of the shares before and the new shares. So you have the weighted average before and the new shares to get the theoretical X right price. That means what each share should be after the bonus issue in theory. So we have example 7 here. It says company E had 3.6 million shares, number of shares in issue on 1st January year 2. Note the years, note the number of shares. Then it made a 1-for-4 right issue on 1st June year 2. So 1st January, 1st June, we have January, February, March, April, May. 5 months before June. So from June we didn't have the same number of shares again. So 5 months we had 3.6 million shares. We'll proceed with that at the current price, at a price of 40 naira per share. So the new shares issued, the 1-for-4 issued, were issued at 40 naira per share. New shares were given at 40 naira per share to the existing shareholders. Now the share price before the rights issue was 50 naira, so they gave them at a discount, and that is the basic key in the definition of a rights issue. It is given at a discount. So the discount here could be 8. The discount here is 10 naira. Now we have total earning here. We are lucky here. Earnings a direct one, not the profit after tax. The total earnings in the financial year to 1st December year 2 were 25,125,000, and the reported EPS in year 1 was 6.4 million. Now in year 1 they've already given us the EPS, so we don't need calculating it. Our interest is year 2 and it has been constant here. It says EPS for the year to 31st December year 2 and adjusted EPS for year 1 for comparative purpose are calculated as follows. Now the 4 existing shares have come right back. That's before the issuing of the new shares. Each shares cost 50 naira, as in the question here. 50 naira per share. Share price just before rights issue is 50. That is the com right issue of share price, 50 naira. So for 4 shares we have 4 times 50, which is 200 naira. Then 1 new share is issued for every 4 at 40 naira. So we have 200 plus 40, which is 240. Now 5 shares that I have in the company, that you have in the company, is worth 240 naira. Now if you want to get the price per share, we would have 240 divided by 5, and the theoretical price that each share is supposed to be 48 naira, not 50 naira as stated. So the theoretical price in theory, each share is worth 48 naira. Because of the discount, there is a reduction there, so there's a 2 naira difference there. And to get it, to perform further calculations, we have actual com right price, which we have as the 50 naira, that's the actual com-rice price, the original price before the issue, divided by the theoretical ex-rice price, which we've gotten as 48 naira here. So to further our calculations, we draw the diagram, the table here, the years. For 5 months, as we stated earlier, we had 3.6 million shares. 5 months is here: January, February, March, April, May. Then from June, we didn't have 3.6 million shares again because we issued new shares. So we go to the diagram here. 5 months, we had 3.6 million shares multiplied by 5 divided by 12. Then we multiply by the right fraction as 50 over 48. We get the weighted average. Now all what we are concerned here is to get the weighted average number of shares. Like I've said, the numerator doesn't change. We have 1,562,500 naira. 1,562,500 units of shares. Then from 1st June, we issued 900,000 shares as in the question here. Okay, the question, you could get 900,000 shares by, you'd say 1 for 4. That means for every 4 shares, you get 1 extra. 3.6 million divided by 4 is equal to 900,000. So for every 4 you get 1, and in 3.6 million you get 900,000 shares. So you have the addition here, 3.6 million plus 900,000. Now in total we have 4.5 million shares. The balance of the month left is 7 months divided by 12. We'd use it, we'll get the multiplication, then we get 2.625 million, 2,625,000 number of shares. We get the addition to get the weighted average number of shares for the company. Now that is how we calculate the weighted average number of shares when there is a right issue in this. Now in our next part, we'll be looking at the diluted EPS. The numerator of this doesn't change, it is just the weighted average number of shares that you need to determine depending on the situation that has occurred as we've outlined above. So we'll be meeting at the next class. Thank you.